State Street Global Advisors released a mid-year outlook earlier this year, and joining me to break it all down and the major headlines is Matt Bartolini. He is the head of Spider America's research at State Street Global Advisors. Good morning.
Morning, how are you?
Good, Matt. So, I'm going to pull up the report right now. So, in the report, it says for the first time in 30 years, the U.S. economy, guided by the Fed, struck the rare soft landing. So, tell me about why you think you and your team, you feel like it's not too early to declare a victory when the Fed still hasn't cut rates. Why do you think that is?
Well, I think part of it is that the Federal Reserve continues to have an evolution of their monetary policy. There continues to be a repricing of rate expectations. So we haven't fully stuck the landing yet. They haven't made that rate cut to sort of signify that they've been able to guide a soft landing
I didn't hear
overall.
what he said.
But the foundations for the actual soft landing are there. So you have a healthy economy, you have growing labor markets, you have overall profits growing as well from a corporate perspective, where you've now had three consecutive quarters of earnings per share growth. So the foundations for the soft landing are there. We just haven't seen the final ending yet where the economy continues to expand after that first rate cut because Federal Reserve policy continues to evolve.
So the report also says that, it's going to get tougher from here for investors. So why do you think that is, and what should investors expect for the rest of 2024?
Well, I think part of it is that, the Federal Reserve does need to sort of stick that landing on their evolution of monetary policy, but the window to affect that policy is closing. You have significant amount of geopolitical risks coming up in the fourth quarter, whether it be elections or other geopolitical events like ongoing wars in the Middle East and Ukraine, but also what we saw the other day with India and their elections and that turmoil that can cause when unexpected events do occur. You have this sort of narrowing window to affect policy. And there's also this idea that perhaps the Fed is waiting too long to cut rates, or maybe they need to hike rates if CPI continues and other inflation metrics continue to be stubborn. So there are a lot of risks to this resilient economy. And that's why we titled the piece Resilience Under Pressure, because there is some pressure building up from a macro perspective. At the same time, on a fundamental basis, valuations for US large cap stocks are inherently stretched, so the price you're paying for future growth has become more expensive. So there are some risks to the system. And I think we can appropriately balance some of these risks by diversifying across mega cap stocks into different areas of the global economy, for instance, into Eurozone, where there's some better valuations, but then also bifurcating those traditional allocations with real assets because of the way inflation is trending, but also those macro risks building up in the system.
So how do you think investors should be positioning their portfolios for maximum returns for the rest of 2024?
But I think where we are now, when we look at it from an equity perspective, you cannot deny the unbelievable growth prospects from technology and technology related stocks. I think there are opportunities though outside of that Magnificent Seven or Superior Six or Fabulous Five, whatever we're calling it these days. So looking across the tech and communication services sectors can still provide that growth. One of our funds has underlying exposure across those segments, and the forecasted earnings per share growth of that portfolio stocks is actually above that of the market and the traditional tech sector. So there's an opportunity to diversify across that Magnificent Seven and reach a little bit further down the cap spectrum, but also on the equity space, going overseas to Europe. You have the ECB likely to cut rates actually just as of tomorrow, but also you have improving economic data and more constructive valuations. So I think that's one way in the equity bucket to maybe perhaps point your portfolio to enhancing returns. On the fixed income side, the economy continues to do well, profits continue to move higher, credit ratings momentum is moving up, there's more upgrades relative to downgrades. So I think having a credit bias could be helpful to sort of manage some of the macro volatility because you're not taking on so much rate risk. So that's what we're looking at for right now. And of course, adding in things like gold or real assets as that tail risk exposure, because there are those macro risks further out on the horizon that could have a volatility inducing type of mentality to your portfolio.
And speaking of volatility, rather, and macro impacts, we are in a presidential election. How do you think investors should be bracing themselves, so to speak, for market moves and headline news?
Yeah, we've actually spent a lot of time talking to end investors, retail clients about this. There's a lot of fear in the system around elections, and rightfully so. Headlines can be somewhat unnerving, but the big picture is that while elections matter greatly for individuals, from a market's perspective, it really doesn't have that long-term of an impact. There can be some short-term volatility spikes as a result of macro surprises or election surprises. Again, India is a great example of that just recently. But we did some research, and if you went to cash, for instance, every time there was an election since 1948, relative to just maintaining an investment and being in the market, you would have underperformed by 9,000% cumulatively since 1948. So having time in the market is better than timing the market. I think that's really important around elections because there is some fear of like, oh, I should be out of the market because it's an election. That's not really true. There are some opportunities to position in areas where there might be policy tailwinds. I think aerospace and defense is one of those. I think that's a bipartisan topic that both parties can agree on in terms of defense spending, both from a cyber perspective, but also traditional spending. So that's one area to look at. But again, don't sleep on election related volatility. There will be some because macro headlines can disrupt sentiment. But on a longer term basis, what drives markets is profits in the economy.
And one ETF that you offer that you believe can help position investors for uncertain monetary policy is the XNTK Spider NYSE Technology ETF. So, talk to me more about this. Tell our viewers who might not know what it's all about and how this product actually helps gives investors an edge when it comes to a very, very busy tech sector.
Yeah, that's actually the fund I was referring to earlier that owns the technology and technology related sectors like communication services, some consumer discretionary, and it is equally weighted across 35 different tech leaders that are, span the globe. There are some ADRs in there of companies in Taiwan. There are some companies over in China as well. So you get a more expansive technology portfolio than what you just find in that Magnificent Seven or whatever we're calling them these days. So it allows you to position your portfolio for that AI related fueled growth for those companies with really durable balance sheets. So their debt to capital ratios are better than that of the broader market. Return on equity is higher. And that can be helpful if we are in a higher for longer environment because of the less onerous impact from financing needs on cash flow. So we really like this exposure to play this idea of generational tech exceptionalism, but in a way that is not so concentrated because there are opportunities outside of the sort of buzzworthy, well-known names. And I think this is a portfolio that can help investors position towards that potential growth. And like I said earlier, if we look at consensus analyst estimates for forward-looking growth for 2024 and 2025, this type of portfolio, the underlying stocks, their expected growth is above that of the market in 2024 and in 2025, as well as above that of the traditional GICS technology sector as well.
A lot of valuable information right there. Thank you so much, Matt, for joining us on today's show.
Thank you.